we all work very hard for our money. And so, if you really start looking at some of these deals out there, and you see a lot of people on social media telling you how to make money using OPM, other people's money, and how to make money, utilizing high leverage, but there's such a risk component to that. And I say this kind of jokingly, but I don't. If I told you, I know the best way for you to make a return on your investment is to take your $300,000 and go to Vegas and put it on 26 on the roulette wheel, spin the ball, and wherever it lands, you're going to either make a ton of money, you're going to make 36 to 1 odds, or you're going to lose it. Most people look at me like, man, that's the dumbest idea ever. And the reason why is because there's debt tied to it, or there's risk tied to it, right? The reason why people don't do that is because they know it's so risky. Let's take a step back and look at some of the real estate deals that have happened over the last 3 to 5 years as it relates to multifamily. For anybody out there that really pays attention to the market, there's been a lot of multifamily assets, hundreds of millions of dollars. There's two big cases in Houston right now where this is where investors got together. Multifamily apartment complexes was the big thing. Everybody was talking about that. So you get these guys that go and raise about $250 million. They take down some large scale apartment complexes. They did a very poor job underwriting it. The bank went from a 3.5% interest rate to an 8.5% interest rate. They didn't lock down that rate. When it changed, they couldn't raise rents high enough to meet that new debt load. So what they have to do, the first thing they have to do is go to their investors and say, hey, I need more money. So there's a capital call. Investors, they had to participate, right? Or their shares get taken away. They participated. And then guess what happened? It wasn't enough. They had to go back to a second round. Do another capital call. So now you're into this thing for at least 50, if not 75% of your initial investment value. And then what happens? They still didn't raise enough money and went back to the bank. So when you talk about risk and we talk about all these type of things, that is part of the reason we do this with no risk. Is because let's say one of our properties doesn't rent out very well for whatever reason, whether it's economics, whether it's weather, doesn't matter. Let's say one of our properties doesn't rent out. Well, to keep a property afloat, you're really talking about taxes, insurance, utilities. As long as you have no debt, and that's relatively cheap. And so for us, we know we can weather storms because we don't have debt tied to this. So we can't guarantee a dividend, right? I'd be foolish to say that we can do that. But what we can almost guarantee is that we're not going to have to lose this asset because we can't pay taxes, utilities, and insurance. Because to operate that is very, very cheap. So again, on a risk-adjusted basis, it's very good. We created this fund very similar to what you would see in the equities world if you bought into, a basket of mutual funds. You're going to have growth, you're going to have growth in income, you're going to have aggressive growth, you might have international. We did the same thing here. You're going to have an international house or two. You can have some conservative houses. You're going to have houses that are just going to appreciate over time. You're going to have some houses that are going to super appreciate because of the location, because of what's going on. Deer Valley is a prime example of that. Deer Valley, we know over time that house is going to vastly outperform most other houses just because of what is going on in and around the neighborhood in which we bought it. And so we know that house is going to blow up for us. And so that's what makes us excited, not only short-term, but long-term. The way we put this together is very methodical, very thought out to return investor money and to make them money, but also to protect their money. Everybody works very, very hard for their money. And I keep going back to this. We do not want to lose it. We, as the general partners, are also investors. We are not doing the OPM. We're not just using other people's money. We are also investors in this.
So what are other asset classes right now that you're seeing? There's other funds that are out there, and how do they compare to not just luxury travel, but the Rêve Estates way?
Yeah, I mean, obviously there's other asset classes out there that, we see that have some upside to it. If that's kind of the question that you're asking, I think, mixed use warehouse is an asset class that has a lot of legs to it. Office, obviously, we all know office right now is getting crushed.
Crushed.
Multifamily continues to be a hot topic. I think you see a lot of the big syndicators out there that are actually pulling back from multifamily.
Mm.
The cap rates are compressed. It's hard to make money. There's a lot of new multifamily being built. So what happens is if you're an investor in multifamily and you are in a class A building, but then something next door is coming up, you're no longer in a class A, you're now class B. So you have to adjust your rates accordingly. But what that does from an underwriting standpoint is, let's say your average monthly rent is $3,000, but now if something next door is coming up and they're going to start at 3,000, you got to go to probably 2,800 to 2,500 just to keep your occupancy rates. Well, if you underwrote that you're going to have an occupancy rate of 80% at $3,000 a night, now you gotta switch the math on that. And so we're seeing a lot of things kind of coming back down on that side. And the other thing that makes us really excited about the short-term rental market, there's not a lot of people playing in the space in a sophisticated manner. There's a lot of one-offs, mom and pops, but there's not a lot of sophistication when it comes to people like us doing this. And so we're on the forefront of that. Obviously, there's a little bit of headwinds that we have to face because of that.
Right.
But we definitely feel long term, more and more people are going to want to be in this space on an institutional level. And we want to be the ones selling to them on an institutional level. So that gives us real big excitement as we look at what, the next 10 years hold.
Yeah, and I'm seeing a lot of build to rent funds right now, and that's a little bit honestly, it's a little closer to apples, in the sense that you're able to invest in one home, and you're able to receive. Now it's obviously not the same ADR, because you're essentially just going, okay, here's a year-long lease or 2-year lease. So you're getting revenue from it, but it is one house that you own. Maybe the fund owns it, but you don't get the lifestyle component. You don't get to be able to use it, and yet you don't get the Airbnb and VRBO rates when there is dynamic pricing. So even build to rent exclusively is almost the closest situation, but it doesn't have all 5 check boxes off.
It does it. And in build to rent, I mean, I like that market. The problem in that market is you have to have a lot to scale to make a lot of money. So if I just buy one build to rent property and the hot water tank goes out, or I gotta, fix the sewer line or whatever it might be, I can lose all my revenue for the year because I have to fix one issue.
Right.
And so the only way to make real money in single family homes is to have scale. And then you got to think, all right, am I managing that or someone else managing that? Mm-hmm. And then not only is it scale, but it's also location, because again, not all real estate is equal. Right. So am I in a market that is appreciating in value, or is it staying stagnant or declining? And so there's so many things that go into that model right there, where if you're just trying to do that on your own and trying to just piecemeal together one at a time, there's a lot of work and a lot of stress. And most people that I know do build to rent, there's also debt tied to it, right? Because that's the easy thing is, hey, put $100,000 down or $50,000 down and you can have this asset and he'll pay you, X percentage over time. Again, yes, if everything goes right. And even if you are making, let's call it a couple $1,000, net a month, that's still $12,000 a year. Is that a life changer for you? Because you still got to scale that to make if you're a sophisticated investor, you still got to scale up to make what I would consider real money.
Exactly. Let's go down that rabbit hole of a DIY investor, someone who's like, hey, I've done fix and flips. Hey, maybe even been a part of fix and flip fund, or you're just like, hey, I just want to take my own 300 grand and buy my own luxury property. Like, what would that process be like if you're just trying to get one luxury property?
Yeah, I mean, that's a great question. Let's say you had a 300,000, right? You can invest 300,000 in me, or 300,000 somewhere else. Let's say you want to go buy, we'll pick Arizona, right? You came to me and said, Brad, I got 300,000. I want to invest, guide and mentor me, right? I'd say, okay, You have $300,000. That's going to buy you roughly $1 million property because you're going to have to put somewhere in the neighborhood of 20 to 30% down. Now, a lot of people are going to say, well, no, you don't. You can do it as a second home and you can only put 5% down. And my short answer is yes, you are correct. So you're going to put very minimal down, which means your payment is going to be high. So from day one, you got to get that thing rented out at a high ADR. $1 million property in Phoenix, Scottsdale, Arizona is going to be a 3-bed, 2-bath, plus or minus a few there, right? That's gonna what you get. That house will not rent at all. It just won't. I can tell you, owning a lot of assets in Arizona, it won't rent. So you're not gonna be able to get it enough to pay it. But then let's just say, okay, I'm gonna put all $300,000 down to limit that. Then what happens is you still got to furnish it. And this is where a lot of people just don't understand this is, a typical $1 million property, you have to have the right type of furniture, the right type of amenities. So you can bank, let's call it somewhere in the neighborhood of $50,000 to $60,000 to furnish a property right. Again, these are nice properties that when someone stays there, the sheets are nice, the mattress is nice, the couch looks nice. This isn't you just go grabbing a couch off of your neighbor's, garage sale and stick it on. It has to have a certain quality if you want to command a higher ADR.
Right.
So now instead of 300,000, you're really about 350. But then you also need to have, a piggy bank saved up for deferred maintenance, for cash reserves to pay the bank. You've got to weather some storms. So you're really probably, let's add another 30 to 40,000 into that. So you're about 400,000. So you're literally $100,000 more than I am for our investments. And now you have to manage it. Are you going to self-manage it or are you going to hire a property manager? A typical property manager is going to charge you somewhere between 20 and 30%. And then they're going to stick it on the OTAs and they're going to kind of go to their next property. Well, every week and month, you're going to sit there and watch, was it booked, was it booked, was it booked? And the reason why is because you got the bank in the back of your mind saying, hey, I need to get paid. And if you don't do that, then they're going to come take the property. It's going to impact your credit and everything else. And so, that's why for us, when we look at this, for the same amount of money, you can own Class A real estate in key destinations that you don't have to worry about to manage, nor do you have to worry about from a debt standpoint. And there's a lot that goes into it. I mean, it's not just, go invest. And these people that say, oh, just, go invest in this property and I can teach and guide you. I've done it hundreds of times. I can tell you it is a full-time job, even if you are not the property manager, because you still have to manage the managers. You still need to make sure what are they doing to get your house booked, your house, not their houses, but your house booked.
Right.
How are you setting yourself apart? There's so many things that goes into that conversation that just most people don't think about, or at least the quote unquote gurus on Instagram and Facebook don't want to tell you about, because it's not as easy as they make it out to be.